Florida's insurance market just crossed a threshold most people haven't noticed yet. A teacher in Tampa, six-figure household income, pristine credit, zero claims in 15 years, just got a renewal notice that tripled her premium to $11,400 annually. Not because of a hurricane, not because of damage, because her zip code is now considered high risk by algorithms that don't care about her perfect payment history. And she's not alone. 12 major insurance companies abandoned Florida in just 3 years, dumping nearly 1.5 million families into Citizens Insurance. A state-run system already showing cracks under pressure it was never designed to handle. The brutal reality? Premiums exploding while property values collapse, neighborhoods getting redlined by entire industries, and equity vanishing for families who thought they'd built something permanent. So what does this actually look like on the ground for real people trying to live in Florida right now? Let's start in Orlando. Number 7, Orlando. You know what's wild? Orlando sits 50 miles inland. No beachfront, no hurricane storm surge risk, no saltwater flooding concerns. This was supposed to be the safe choice, the sensible Florida that avoided all the coastal chaos. So why are families here staring at $4,500 to $7,000 annual premiums for standard single-family homes? The answer reveals something most people miss about this crisis. Orange County's explosive growth over the past decade created something insurers call concentration risk. Hundreds of thousands of policies stacked into one metro area. When companies reassess their Florida exposure, they're not just asking, did hurricanes hit here? They're calculating total financial exposure across entire regions. And Orlando's sheer size? That makes it a prime target when carriers plan their exits. But wait, it gets worse for newer construction. Those pristine subdivisions built from 2019 to 2023, the ones marketed as brand new, worry-free homeownership, many are facing systematic denials because insurers are quietly questioning the construction quality during Florida's building boom. Families who paid premium prices for new homes discover their properties are being labeled too risky at any reasonable rate. See what's happening? The insurance crisis isn't respecting anyone's assumptions about safe versus risky locations. It's rewriting the rules across the entire state. And Orlando proves that being inland doesn't protect you anymore. The devastation only intensifies as we head south to our 6th city. Number 6, Naples. Down in Collier County, Naples still looks like paradise at sunset. Luxury yachts cutting through calm waters, Mediterranean-style estates lining pristine coastline, Fifth Avenue packed with affluent retirees, living the dream they spent decades working toward. But something's breaking behind that perfect image. What's destroying Naples looks like this. Luxury homes are facing annual premiums between $15,000 and $35,000 now. Waterfront estates, many are pushing $50,000 to $80,000 just for basic coverage. And that's before property taxes or HOA fees enter the equation. The real shock hits at the community level, though. Country clubs and gated developments are reporting master insurance policy explosions of 300% to 500% in single renewal cycles. What does that mean in practice? Well, associations that budgeted $180,000 for annual coverage suddenly face bills of $720,000 to $900,000. Those costs get passed directly to residents through special assessments that arrive like financial grenades. Pelican Bay, Port Royal, Aqualane Shores, neighborhoods where homes sell for $5 million to $20 million, are discovering that multiple carriers won't even quote new policies anymore. And existing coverage, it comes with hurricane deductibles of $100,000 to $250,000, which basically means the insurance only matters if your home gets completely destroyed. Think about retirees living on $180,000 annual income. Insurance eats $18,000. Condo fees jump to $24,000. Property taxes hit $22,000. That's $64,000 gone before utilities, healthcare, food, or helping family. Naples reveals an uncomfortable truth. Wealth can't solve a problem when the entire insurance system stops functioning rationally. And compared to what's happening in our 5th city, Naples is just the opening act. Number 5, Jacksonville. Jacksonville marketed itself as Florida's practical choice for years. Major metro area without Miami prices. Coastal access without Tampa's hurricane vulnerability. Big city jobs with reasonable costs. The sensible compromise. Turns out insurance companies don't price based on marketing slogans. They price based on what their risk models predict is coming. Across Duval County, premiums have jumped 40% to 85% in just 2 years. Let that sink in. Families in Riverside, San Marco, and Mandarin, neighborhoods that haven't seen major hurricane damage in decades, are facing $5,500 to $8,500 annual premiums for standard homes. Not luxury properties, not beachfront estates, regular middle-class housing. The coastal corridor gets hit even harder. Jacksonville Beach, Atlantic Beach, Neptune Beach residents are watching long-standing policies get canceled outright as insurers slash their coastal exposure. A property that carried a $4,200 annual premium now gets quoted at $9,800 from Citizens Insurance, if coverage is even available. Then FEMA's remapping project dropped. Thousands of homes got reclassified from low-risk to moderate or high-risk flood zones. That shift triggers mandatory flood insurance requirements, adding $2,000 to $5,000 to annual housing costs. So families who bought in safe areas wake up to letters saying they're now in flood zones requiring coverage they never budgeted for. Military families stationed at Naval Air Station Jacksonville or Naval Station Mayport face particularly cruel timing. Service members buying with VA loans discover insurance costs alone blow up their debt-to-income ratios, pushing them out of home ownership entirely. What's destroying Jacksonville would be headline news anywhere else. But in this crisis, it's only number 5, because our 4th city faces even more severe devastation. Number 4, Tampa. At golden hour, Tampa's Riverwalk feels like the future. Glass towers reflecting Hillsborough Bay, families filling armature works, downtown buzzing with energy, the Gasparilla pirate ship silhouetted against the skyline. Tampa was booming. Population growth, job creation, cultural renaissance, the whole success story. But behind that gleaming skyline, an insurance catastrophe is quietly bleeding the city out. Average home premiums hit $6,800 to $9,200 annually now. For families earning $102,000, that means insurance alone devours 8% to 9% of gross income before touching mortgage principal, property taxes, or utilities. You see the problem? That's unsustainable math even for solid middle-class earners. Condo associations across South Tampa, Hyde Park, and Davis Islands are getting absolutely hammered. Master policy premiums exploding 350% to 600% in single renewal cycles. So what was $2,400 annually per unit becomes $10,800 overnight. Retirees on fixed incomes and young professionals alike are staring at fees they simply cannot absorb. Updated FEMA flood maps reclassify safe neighborhoods into high-risk zones, tripling premiums for families who lived there 25 years without filing a single claim. And several major insurers, Farmers, AAA, Allstate, stopped renewing policies across Hillsborough County entirely, forcing tens of thousands into Citizens where rates jump again. The housing market reveals the damage in brutal detail. Listings sit for 94 days on average, while for sale signs fade in the Florida heat. Sellers slash prices by $40,000, then $60,000, then $90,000, trying to attract buyers who vanished. Real estate agents repeat the same devastating line. Perfect house, great schools, motivated seller, zero offers. Tampa isn't collapsing from crime or job losses. It's drowning in insurance costs that even high earners can't sustain. The crisis deepens dramatically when we examine our 3rd city. Number 3, Cape Coral, Fort Myers. Southwest Florida's Lee County still looks beautiful at sunrise. Cape Coral's canal system winding through waterfront developments, Fort Myers' historic downtown along the Caloosahatchee River, beaches stretching toward Sanibel Island. This was marketed as Florida's last affordable paradise. Waterfront living at prices normal families could actually reach. Hurricane Ian shattered that illusion permanently, and the insurance system, it never recovered. Cape Coral and Fort Myers now sit at the absolute epicenter of Florida's insurance catastrophe. Standard single-family homes in Cape Coral face annual premiums of $10,000 to $14,000 now. That's $1,200 monthly just for insurance on properties losing value every quarter. Fort Myers residents face identical devastation, $9,500 to $13,500 annual premiums, with systematic renewal denials forcing families into Citizens at even higher rates. Ian didn't just damage these cities physically, it shattered the risk models that insurers relied on. Major carriers refuse to write new policies across large portions of Lee County entirely now. Existing policyholders open mailboxes to find non-renewal notices at rates not seen since Hurricane Andrew devastated South Florida in 1992. Cape Coral's overbuilding creates additional disaster layers. Thousands of homes thrown up during the 2020 to 2022 construction frenzy sit completely empty now. Windows dark, lawns dying, developer incentives reaching desperation levels with zero buyer interest. We're talking roughly $2.8 billion in stalled real estate inventory that simply can't move because insurance costs push buyers over their debt-to-income limits. Fort Myers neighborhoods demonstrate the circular trap with mathematical precision. Premiums rise, so buyers disappear. Without buyers, home values drop 12% to 18% below peak. Lenders see declining values and require more coverage. Additional coverage requirements push premiums higher. Sellers panic and slash prices. Price drops signal declining markets to insurers. Insurers raise rates again or exit completely. Families trapped in Ian-damaged areas face impossible choices. Can't sell because buyers need insurance that doesn't exist. Can't rebuild because contractors demand proof of coverage first. Can't refinance because lenders see insurance costs as default risks. Can't walk away without credit destruction. Lee County shows us what happens when insurance systems don't just strain, they break completely. But even this epicenter isn't the peak of the crisis. Number 2, West Palm Beach, Palm Beach County. Palm Beach's legendary coastline still draws the eye. Oceanfront estates worth $25 million overlooking pristine Atlantic beaches. Worth Avenue packed with luxury boutiques, private clubs where initiation fees exceed most Americans' lifetime earnings. This is where generational wealth displays itself under Florida sunshine, where market corrections supposedly don't matter, where money solves every problem. But 2025 is revealing a harsh truth. Even Palm Beach County is buckling under insurance catastrophe that wealth cannot fix. In Florida's richest county, the damage looks like this. Multi-million-dollar estates face annual insurance premiums of $35,000 to $75,000 now, and those numbers keep climbing monthly. Luxury high-rise condos across West Palm Beach, Boca Raton, and Palm Beach Island experience building-wide premium explosions of 250% to 450%. So a condo unit that cost $5,200 annually to insure now demands $15,600 to $23,400. Associations pass those costs through special assessments that arrive like financial grenades, $48,000 bills due in 90 days, or face liens against properties. The truly surreal development. Thousands of ultra-luxury properties are getting forced into Citizens Insurance, the state-run last resort carrier originally designed for struggling middle-class homeowners who couldn't find private coverage. A decade ago, the concept of a $20 million Palm Beach estate relying on Citizens would have sounded absurd. Today, it's becoming standard operating procedure. Flood insurance under FEMA's Risk Rating 2.0 system delivers another knockout punch. Waterfront properties see rates triple and quadruple as new modeling reveals long-term risk that previous assessments systematically underestimated. Oceanfront owners discover that beachfront living comes with annual insurance costs of $65,000 to $120,000, exceeding many Americans' entire gross income just for property insurance alone. At that point, even ultra-wealthy families start asking hard questions. Is the status of a Palm Beach address really worth burning 6 figures annually just on insurance? The Palm Beach market isn't experiencing a correction. It's experiencing structural breakdown of a luxury ecosystem that operated for 50 years on assumptions that no longer hold. International investors who viewed Florida real estate as bulletproof wealth storage are quietly exiting. Foreign buyers from South America, Europe, and Asia, the same people who drove prices for decades, have disappeared entirely. And if the wealthiest county in Florida is cracking under this pressure, what's happening to Miami reveals the complete unraveling of a world-class city. Number 1, Miami and Miami-Dade County. Miami's iconic skyline at dusk still takes your breath away. Brickell's glass towers piercing the twilight sky, South Beach's Art Deco buildings glowing with neon energy, cruise ships departing government cut while yachts dot Biscayne Bay. For decades, Miami wasn't just a city. It was a global brand, a lifestyle, a promise that anything was possible under the Florida sun. That promise is collapsing under the weight of mathematical reality. Miami-Dade County now carries the highest residential insurance premiums in the entire nation. Luxury condos in Brickell, Edgewater, and Miami Beach face annual premiums reaching $22,000 to $58,000 for individual units. But the real crisis hits at the building level. Entire high-rise associations see master insurance policies explode from $2.4 million to $9.8 million in single renewal cycles. That forces special assessments of $45,000, $72,000, even $95,000 per unit that owners must pay immediately or face automatic liens and potential foreclosure. HOA fees across Miami's luxury towers have jumped 320% to 680% in just 30 months. Buildings that charge $950 monthly now demand $3,800. Retirees on fixed retirement incomes receive bills they cannot possibly pay. International investors who bought condos as appreciating wealth storage discover their safe assets have become financial black holes requiring constant capital injections just to prevent association liens. The market response? Pure panic spreading through every price tier. Nearly 1 in 5 listed properties in Miami-Dade gets delisted. Owners giving up after 120+ days without serious offers. Unable to sell. Unable to afford insurance. Unable to escape. Foreign buyers who drove Miami's decades-long luxury boom have evaporated completely. South American investors see better risk-adjusted returns elsewhere. European buyers question long-term viability when insurers are systematically exiting. Asian capital that once flooded into Miami Beach penthouses doesn't return phone calls anymore. Sea level rise projections paint a nightmare scenario that insurers are already pricing into their exit strategies. Updated modeling shows large portions of Miami Beach, Key Biscayne, Aventura, and downtown Miami experiencing regular tidal flooding within 15 to 25 years. Not from hurricanes, but from normal high tides amplified by rising seas. Insurance companies see the same projections. They're not planning for Miami's future. They're planning their complete withdrawal. Multiple major carriers have already cut entire zip codes from their coverage areas. Properties in Sunny Isles Beach, Bal Harbor, and South Beach face systematic policy denials regardless of condition, hurricane shutters, or claims history. Coastal high-rises discover that no private insurer will touch them at any price point. Citizens Insurance absorbs 120,000 plus Miami-Dade policies and counting, a state system that was never designed to insure an entire major metropolitan area. The compounding crises feed on themselves with brutal efficiency. Rising seas meet rising premiums. Declining buyer interest accelerates seller panic. Collapsing condo associations trigger building safety failures and deferred maintenance crises. Insurance companies abandon entire neighborhoods. Property values enter freefall in areas where coverage becomes impossible to secure at any cost. This is the systematic unraveling of a global city's housing market, driven by insurance costs that exceed what even wealthy international buyers can justify and climate risks that insurers refuse to underwrite at any premium level. Miami shows us what happens when insurance system collapse hits a major American city. The warning signs suggest this is just the beginning of a transformation that will reshape American coastal living permanently. Conclusion and final take. So let's be clear about what we're watching unfold. Florida's insurance collapse is not a temporary crisis that resolves with better politics or improved hurricane forecasting. It's not a market correction that finds a bottom and bounces back. It's not an accident of unfortunate timing or regulatory failure. This is a structural shift driven by mathematical reality. Climate change, sea level rise, and increasing storm intensity are creating insurance costs that middle-class families cannot afford and risks that companies cannot profitably underwrite. The 7 cities we investigated tonight, Orlando, Naples, Jacksonville, Tampa, Cape Coral/Fort Myers, Palm Beach County, and Miami, represent different stages of the same collapse spreading across Florida's entire housing market. And this is what comes next, based on data already in motion. As major insurers continue exiting Florida entirely, premiums will keep exploding for the 1.5 million families trapped in Citizens insurance. As flood maps get updated with better climate modeling and sea level projections, hundreds of thousands of additional safe properties will get reclassified into high-risk zones overnight. As property values decline in insurance-stressed markets, tax revenues will collapse, forcing cities and counties to cut essential services precisely when residents need them most. The compounding effects accelerate even faster from here. Insurance-driven exodus triggers home value collapse. Home value collapse forces more insurers to exit. More insurer exits push additional hundreds of thousands into Citizens. Citizens' growing exposure creates legitimate solvency concerns. Solvency concerns trigger emergency premium increases. Premium increases force more families to sell or abandon properties. If you currently live in Florida, you need to understand these forces are accelerating before they trap you financially in a property you cannot sell. If you're considering a move to Florida, calculate total insurance costs, homeowners plus flood plus wind plus umbrella, before falling in love with a property that becomes unaffordable. If you own Florida real estate as investment, develop exit strategies now for scenarios where insurance becomes unavailable at any price. Because for millions of families across these 7 cities, the insurance crisis has already destroyed their financial security, their equity, their retirement plans. For millions more across Florida, the catastrophe is still approaching. And when it arrives in their neighborhood, the escape routes will have vanished. Hit that subscribe button. We're tracking the collapse that mainstream media refuses to acknowledge. And in our next investigation, we're exposing the California cities where insurance companies are implementing the exact same exit strategies, while local politicians stay silent. The insurance crisis is spreading nationwide. The question is whether you'll recognize it coming before it reaches your street.